All right, so today we're going to be taking a deep dive into some investing wisdom.
Sounds good to me.
We've got some excerpts here from a financial podcast called Money Moves,
Okay.
and they're breaking down one of the all-time classic investment books, The Intelligent Investor by Benjamin Graham.
Oh, yeah, that's a good one.
Yeah, and some people say that reading that book, it's kind of like having a playbook for smarter investing.
I would agree with that.
What do you think?
Yeah, I think that's a really good analogy. Um, Graham's work is really like the foundation. If you want to build a solid understanding of investing,
Yeah.
especially if you want to kind of move past all the hype
Right.
and really make those clear-headed decisions for the long haul.
Yeah, and that's something the podcast hosts talk about right away is,
Yeah.
who is this intelligent investor?
Right.
It's not about trying to, time the market perfectly or
Yeah.
chase all the latest trends like, you're some kind of financial ninja.
Exactly. It's not about being the most clever or the fastest.
Yeah.
It's about understanding the underlying value of a company.
Mm-hmm.
Think of it this way, like a fruit tree.
Okay.
Its real worth is in all the fruit it can produce over its lifetime. Not just the price that someone offers for a couple of pieces, today.
I like that.
So that's what the intelligent investor really focuses on, is the long-term potential.
Right.
Not just what's happening day to day with the stock price.
Yeah, well, and let's be honest, that's hard to do.
Oh,
When
absolutely.
you're looking at those numbers jumping up and down every day.
Yeah, we've all been there.
Oh, yeah. I've definitely fallen into that trap before.
Absolutely. And that's exactly where Graham's famous Mr. Market analogy comes in.
Okay.
So picture this. The market is like a person, and this person is super moody, up one day, down the next.
Yeah.
And this is Mr. Market.
Right.
And Mr. Market wants to buy or sell your stocks every single day.
Mm-hmm.
And the prices are totally driven by, these wild mood swings.
I think I already know a couple Mr. Markets in my life.
Right.
So, but I'm guessing the key here is not to let Mr. Market, drag us into his drama.
Yeah, you got it.
Okay.
Don't get caught up in his, theatrics. The intelligent investor doesn't panic sell when Mr. Market throws a tantrum
Okay.
and prices plummet.
Yeah.
And they also don't go all in just because Mr. Market is, suddenly super optimistic.
Right.
They stay focused. They see through the, the noise and the ups and downs.
The drama.
Yeah. And they make decisions based on what a company is truly worth,
Mm-hmm.
not just what the market thinks it's worth on, any given day.
So they're not letting their emotions drive their investing decision.
Exactly. That's a great way to put it.
Okay.
And one of the best examples of this playing out is the dot-com bubble.
Oh, yeah.
You remember back in the late 90s, all those tech companies with just, sky-high valuations?
Yeah, but everyone thought they were going to be millionaires overnight.
Exactly. And a lot of people bought into that hype, but the intelligent investors, they saw through it. They recognized that the fundamentals of those businesses just didn't support those crazy prices.
Right.
And many of them, avoided the crash when the bubble burst.
Yeah, that's a good reminder that sometimes the market can just get things totally wrong.
Right.
So how do we avoid those traps?
Mm.
What is the secret sauce here?
Well, Graham has a few more tools in his toolbox.
Okay, I'm listening.
One of the big ones is the idea of a margin of safety.
Margin of safety.
Yeah, and it's actually pretty straightforward. Basically, you want to buy stocks at a price that is significantly lower than what you believe the true value of that company is.
Okay, so if I think a company's worth, let's say $100 a share,
Yeah,
I shouldn't buy it unless it's trading for maybe $70.
exactly. You got it.
So build in that little discount.
Yeah, that $30 difference, that's your margin of safety.
Okay.
It's like when you're negotiating for a used car,
Right.
you always want a little wiggle room.
Yeah, just in case there's some, hidden problems.
Yeah.
Exactly. You don't want to pay full price and then find out later that, it needs a whole new engine.
Right, exactly.
So the margin of safety, it helps protect you from those unexpected downsides.
Okay.
And it gives you a cushion if your initial assessment was, maybe a little bit off.
It's a really good way to think about it.
Yeah, it's all about managing risk.
Hmm.
Now, building on this idea of, the margin of safety and thinking about risk, Graham also talks about two main types of investors.
Okay,
You got the defensive investor
right.
and the enterprising investor.
Okay, this is interesting. I'm already trying to figure out which one I am.
Yeah, well, the defensive investor is all about seeking those steady, reliable returns
Okay.
without having to constantly watch the market.
Okay.
They're prioritizing stability,
Mm-hmm.
and they're often choosing investments like blue chip stocks,
Okay.
diversified mutual funds, and maybe some bonds.
So it's kind of like the set and forget it approach.
Exactly. Low maintenance investing.
I like that.
Yeah. But what about those enterprising investors?
Right. Are they the ones taking a little more risk?
You could say that they're a bit more hands-on.
Okay.
They're willing to do the research, really dig into those financial statements
Okay.
and actively search for companies that are undervalued by the market.
So they're looking for those hidden gems.
Exactly. They're looking for the potential for higher returns, but it does require more effort
Right.
and a bit more risk tolerance.
Do they have a crystal ball or something?
I wish.
Right.
No, they rely heavily on their analysis skills.
Okay.
A great example is Warren Buffett
Okay.
and his investment in Coca-Cola.
Oh, yeah.
He bought a large stake in the company after its stock took a dip
Mm-hmm.
because he saw the long-term value, even when other people were hesitant.
So he wasn't just bargain hunting.
Right.
He saw a good company that was, temporarily on sale.
Exactly. He was looking beyond that immediate market sentiment
Right.
and focusing on those fundamentals. But here's the thing. Graham also cautions against chasing those flashy quick profits.
Mm-hmm.
Or assuming that just because a company has done well in the past,
Right.
that it's guaranteed to continue to do well in the future.
So even if a company's doing great right now, that doesn't mean it's going to be a winner forever.
Exactly. You got to look beyond the headlines and really figure out if their success is sustainable.
Okay. So how do we do that? How do we figure out if it's sustainable?
That's a great question.
It sounds like a whole other deep dive.
It is. We could definitely do a whole deep dive on that.
Yeah. Where do we even begin to analyze a company like that?
Well, it can definitely seem daunting at first, but remember those two types of investors we talked about?
Right. The defensive investor and the enterprising investor.
Exactly.
Are you saying that one might be more equipped to handle this kind of analysis?
Yeah, in a way, I think that's true. The defensive investor who's looking for that stability and that steady growth,
Mm-hmm.
they might stick with, those well-established companies. The ones with that long history of solid earning.
Right. The big names that you always hear about.
Exactly. The ones that have been around forever.
Yeah.
Less risk, but also maybe a little bit less reward.
Okay. Is that kind of what Graham's getting at?
Yeah, it's a trade-off for sure.
Right.
Now the enterprising investor,
Right.
they're a little more willing to, roll up their sleeves and dig in,
Okay.
really get into those financial statements.
Mm-hmm.
They're looking for that hidden value,
Okay.
those signs of a turnaround or a growth spurt that maybe the rest of the market hasn't quite noticed yet.
So they're like financial detectives,
I love that analogy.
right? Uncovering the clues
Yeah, piecing together a story.
that everyone else is missing.
Exactly. And it's not just about finding a stock that's cheap.
Right.
It's about understanding the whole picture.
Okay.
What's the company's story? How strong is their position in the market? What are their competitive advantages?
You're making me feel like I need to take a crash course in accounting or something.
You don't have to be a Wall Street whiz
Okay.
to get started with this stuff. There are a ton of resources out there
Okay.
to help break down these concepts.
Like what?
Websites like Investopedia,
Okay.
they can walk you through, all the basics.
Mm-hmm.
There are even some great YouTube channels
Oh, wow.
that explain financial statements, in plain English.
Okay. So it's not as intimidating as it might seem at first glance.
Not at all. And, that's one of the things that makes Graham's work so important. He really wants to empower everyday people
Okay.
to understand the world of investing,
Yeah.
not just, leave it to the so-called experts.
Right. So you can do this.
Exactly.
You can learn the ropes.
Yeah,
You can make those smart decisions without having to rely on someone else to tell you what to do.
exactly. It's about taking control of your financial future
Mm-hmm.
and making those informed, rational choices based on your own analysis and your own goals.
Right. And, one of the things that the podcast host really emphasized was that even when a company seems like it's doing well,
Mm-hmm.
you still have to kind of question whether those profits are really sustainable.
Right. Just because they're raking it in now doesn't mean that it's a guaranteed home run in the long term.
So just because they're killing it now doesn't mean it's going to last forever.
Exactly.
Yeah.
You got it.
Okay.
Remember those companies that were posting those record profits
Uh-huh.
right before the 2008 financial crisis?
Oh, yeah.
A lot of them crashed hard when that bubble burst.
Right.
Past performance doesn't always guarantee future results.
That's a good reminder that things can change really quickly.
Absolutely.
So how do we avoid those kinds of surprises?
Well, the intelligent investor, they look beyond the hype.
Mhm.
They look beyond the current trends. They
Right.
ask those tough questions.
Like what?
Like, are these profits based on real innovation?
Mm-hmm.
Are they based on a solid business model?
Right.
Or are they just riding a temporary wave that's bound to crash sooner or later?
So it's about not getting swept up in the excitement of a moment.
Yeah,
It's about taking that step back and really looking at the bigger picture.
exactly. And a big part of that is understanding the difference between value and price.
Okay.
Price is what the market is willing to pay for a stock today.
Right.
Value is what that company is truly worth
Mm-hmm.
based on its fundamentals.
Okay.
The intelligent investor looks for those companies where the value is much higher than the price.
Okay.
That's where the real opportunities lie.
That makes sense.
Hmm.
But I have to admit, listening to all this,
Yeah.
I'm starting to realize how much I've let my emotions kind of drive my investment decisions in the past.
Mm-hmm.
It's like I've been on this financial roller coaster,
Yeah.
getting excited when things go up and panicking when they go down.
It's a common trap,
Yeah.
especially in today's world where we're just bombarded with financial news
Right?
and market updates all the time.
It's hard to tune out that noise.
It is. It's easy to get caught up in the frenzy and lose sight of those long-term goals.
So what's the antidote to all of this noise and emotion?
Well,
What does Graham prescribe for investors like me who need a little more,
yeah.
let's say, emotional stability in their financial lives? So what's the antidote to all of this noise and emotion? What does Graham prescribe for investors like me who need a little more, let's say, emotional stability in their financial lives?
Well, you've hit on a key point there. It's about tuning out that noise and embracing a long-term perspective. And that brings us back to one of the most fundamental principles in The Intelligent Investor.
Patience. Patience. I'll admit that's not always my strong suit, but I'm definitely willing to hear him out on this one.
Right.
Especially if it means a smoother ride for my portfolio.
Think of it this way. You wouldn't yank up a tomato plant every day to see if it's growing right.
Right.
You trust the process, you give it sunlight and water, and you let it do its thing.
Okay.
Investing is similar. You got to have faith in your strategy and let it grow over time.
That's a much better visual than constantly checking my stocks and freaking out over every little dip.
Exactly. And the podcast hosts made a great point about this. They compared investing to planting a tree. You nurture it, you give it time, and eventually it bears fruit. Trying to rush the process or constantly tinkering with things can actually do more harm than good.
It's like they're saying chill out and let nature do its thing, which honestly is a message I could probably apply to more areas of my life.
Yeah.
But how does this patience thing actually play out in the world of investing?
Well, for starters, it means not getting spooked by those short-term market fluctuations. Remember Mr. Market?
Oh, yeah, he's always working.
He's always going to be there trying to tempt you with his emotional roller coaster.
All right.
But the intelligent investor knows that the real game is played out over years and decades, not days and weeks.
So it's about focusing on that long-term growth rather than trying to time the market or chase those quick profits.
Precisely. And one of the most powerful tools you have in this long-term game is compound interest.
Okay, compound interest. It's like a snowball effect, right?
Exactly. Your earnings start earning their own earnings, and over time it can create incredible wealth.
I've definitely heard about the magic of compound interest. But I'll admit, sometimes it's hard to wrap my head around.
Yeah, it can be a little tricky to grasp at first.
So how does that actually work in practice?
Well, let's say you invest $1,000
Okay.
and it earns a 10% return in the first year.
Right.
Now you have $1,100.
Okay.
But in the second year, you're not just earning 10% on that initial $1,000. You're earning 10% on the $1,100.
Oh, I see.
And so on year after year,
Okay.
the longer you let those earnings compound, the more powerful that growth becomes.
Wow. Okay, I'm starting to see the light here. It's like those small, consistent gains can really add up to something much bigger over time.
Exactly.
It's almost like planting seeds.
Yeah.
Each one might seem insignificant on its own, but together they can grow into a whole forest.
That's a fantastic analogy. And that's the beauty of long-term investing. It's not about getting rich quick. It's about making those smart, consistent choices and letting time work its magic. And that takes patience and discipline, which are two qualities that Graham emphasizes throughout the book.
So how do we actually cultivate those qualities?
Yeah.
Do we need to become Zen masters or something?
Well, it's definitely a process, but it starts with understanding yourself,
Okay.
your risk tolerance, your financial goals, and your investment timeline.
Right.
Are you someone who can handle a more hands-on approach, like the enterprising investor?
Mm-hmm.
Or do you prefer a more passive, set-it-and-forget-it strategy like the defensive investor?
Yeah. I'm realizing that there's no one-size-fits-all answer here. It's about finding what aligns with your personality and your individual circumstances.
Absolutely. And remember, it's a journey, not a destination. You're always learning, adapting, and refining your strategy as you go. The key is to stay informed, Keep educating yourself and never stop asking questions.
This has been such an eye-opening deep dive. I feel like I'm starting to see the world of investing in a whole new light. It's not about gambling or trying to outsmart the market. It's about
Yeah.
making informed, rational choices based on sound principles and letting those choices grow over time.
That's the essence of what Graham is trying to teach in The Intelligent Investor. He wants to empower individuals to take control of their financial future and make decisions that align with their long-term goals. And he reminds us that it's not about being the smartest person in the room, it's about being disciplined, patient, and focused on the fundamentals.
I think I'm going to add this book to my must-read list immediately.
I highly recommend it.
And for our listeners, if you're looking for a framework to approach investing with more confidence and less emotion, The Intelligent Investor is definitely a great place to start.
Couldn't agree more. It's a classic for a reason.
Awesome. Well, hey, thanks for joining us on this deep dive into the world of intelligent investing.
It's been a pleasure.
We'll see you next time for another fascinating exploration of knowledge and ideas.